So Lemonade's Q4 letter just came out a few hours ago. I've been reading through it, thinking about it, digesting it, and I want to give my thoughts. First of all, I'm going to share a number of really positive highlights that I see from the letter and from my own analysis and my own model, and then a couple concerns and possible concerns even might be driving the after-hour spike downwards in price, and talk about those concerns. So let's dive into it. First of all, let's talk about the premium. 747 in-force premium, huge beat on the 729 that they had guided for. So I really didn't make sense, this guidance number to me. I thought it was way too conservative. In my own numbers, I always had sort of a possible scenario I was suggesting 750 million range. So 747, really strong beat in in-force premium, really positive. 2,026,000, almost 27,000 customers. I was actually, in my slightly more bullish case, was estimating about just slightly less in customer count. So actually grew customers a little bit more than I was expecting. Gross loss ratio, 77%. Now, I tweeted this out earlier in the day, earnings day here. Things I'm looking for, loss ratio. Hey, if it's over 80, that's bad. 75, 79, that's good. Less than 75%, great. And I was hoping 74%. Some people were even suggesting it could be lower than that. And I was seeing arguments of why that could have been the case. So 77%, I'd say is still good, but a little bit disappointing of what, we were sort of hoping for, less than 75. But not bad, certainly a major improvement. Adjusted EBITDA, another super positive thing. They were guiding for about minus $42 million loss. But of course, adjusted EBITDA came in at about minus $29 million loss. And if you look at my own side math, I was saying, hey, potentially low 30s, that scenario. So really positive scenario there, having adjusted EBITDA come in under $30 million loss, which I feel like people aren't really talking about and just sort of taking that for granted or glossing over that huge improvement in adjusted EBITDA as they march forward on their path of profitability. And you put adjusted EBITDA in a graph in the context of all other quarters, you can see that they're in a very positive trend in the right direction ever since I said Q3 2022 was going to be peak losses. So this, to me, gets me very excited, very bullish, because this is the thing. In the long term, the market cares more than anything about how much future cash flows can you create. What's that value now? So they're showing us that they're marching towards profitability, and this was a bit of a surprise, even being under 30 million for me. So really great thing that I think the market's glossing over. Other very positive thing is that their churn has dropped now to 16.8%, the lowest it's ever been. It continues this downwards trajectory. 16.8% customer churn. That's customers who churn over a 12-month period of time. So really positive to see that continuing. Also, if we go to the next slide, it says amount of churn from 12 months prior. So the actual number of customers, which you can see is about 300,000, is around that range. Every 12 months, about 300,000 of the customers churn. But for the last 4 months, even though the total customer count has continued to rise, you're getting a bigger base of customers, that stayed relatively steady, which of course makes sense in the context of churn has also continued that decline as customer count has gone up. And then finally, customer acquisition costs. So customer acquisition costs, this is a bit of an estimate because we don't have the final numbers yet on how much CAC spend they had specifically out of their sales and marketing, but we can estimate it pretty well just based on other quarters. And based on what I'm estimating, they're at it's about $109 per customer, similar to other quarters where they've been, or even a little bit in the sort of maybe on the better side of average, but a little bit worse than the last couple quarters where they had really positive, really low CAC, but still really great. And what I looked up for other legacy insurers, it's difficult to really, I think, measure, but because there's so many different kind of customer acquisition channels, and the cost of those channels might have very different amounts of time periods. Some might be very upfront costs, like Lemonade has. Some might be through an agent, and they extract premiums away from that for that customer over the life of that customer. So it's different to track those. But what I found was that most insurers have, it's more in the range of $500 at the better end, $900 range. So Lemonade's only at $109. I think this is in part because they're really playing in the renter space. They're really playing in the pet space. So those are lower premium products that are less competitive products, so you can get a customer for cheaper there than, say, someone competing for car insurance, home insurance, etc. And on top of that, Lemonade has really, really efficient systems, really, really automated claims handling of pet claims, of renters claims, so that can lower their overall, keep their loss ratio low, but still have their prices be the best prices in the market. So that's going to help your customer acquisition as well. So that's sort of, the big secret sauce of Lemonade, is that they should be able to grow customers for cheaply and then grow with them over time. Another really positive thing from the quarter is that the combined ratio, loss ratio, expense ratio all continue to trend down. So I have a graph of that trend ever since the information we have on Lemonade, but continues that downward trend. And actually, if you look at the numbers, your total operating expenses, it went from $98 million last quarter down to $90 million this quarter. Now, that's in part because there was $6.7 million that was Metromile one-time related expenses. But even if you back those out, they were at 91.6 last quarter, and then they're at 90.7 this quarter. So fairly steady or even slightly down, even though they're continuing to grow the top line. That's the sort of operating leverage we should continue to expect from Lemonade, and that management has told us in previous quarters that, hey, they're built for scale now, they're going to continue to scale, and then these expense lines, like other insurance expense only up 3%, tech development down 3%, G&A is down 40%, partly because of that large one-time expenses. If you back those out, though, again, it's still down 4% quarter over quarter. So still improving and moving in the correct direction. So really encouraging to see that, and 50% of total expenses as a percent of gross earned premium, your expense ratio there was better than I was kind of expecting. I was thinking, it might be like 52, 51%, somewhere in that. So 50%, again, even better, a little bit better than I was expecting. Another really positive thing from Q4 for Lemonade was this graph of adjusted EBITDA to gross earned premium. It continues its direction towards breaking even and then profitability. Of course, this picture here and all the pictures, this all comes from my Lemonade model. If you want to get the full access to the model, you can join my Patreon, and you'll get full access there. But this adjusted EBITDA gross earned premium, as you can see, out to have it going out right now, end of 2027. You see we're on that path of profitability sometime right around 2026, which is roughly what management has been saying they'll be hitting that point. Other really positive things is that their cash position basically didn't change at all in Q3 or Q4. So people saying, hey, they're going to run out of money. People were saying that for like all of last year. Hey, Lemonade's going to run out of money in 2 years. They're going to be gone. They're going to run out of all their money in 2 years. Like for the last 6 months, their cash position literally did not change. And they go on later in the letter explain, hey, we're not really fully cash flow consistently positive yet, but we're definitely on the way to get there. And really positive to say, hey, they're accelerating top line growth, improving the bottom line 2024, cash flow positive by during 2025, adjusted EBITDA positive during 2026, which they said last quarter, but again, reiterating that and sort of this is new, accelerating top line growth. What exactly does that mean? We'll talk about that again in a bit. Another positive thing is they have this graph where they talk about in-force premium and adjusted EBITDA. Now, these basically are tracking, not exactly, but fairly linearly to one another consistently. Over this span of time, they have about the sort of same relative change. If you do a little bit of thinking around this graph and say, hey, there was about $138 million change in IFP, and that resulted in about a $38 million change in adjusted EBITDA. If that carries forward into the future, 138, that relative change times by 29 million more, say, to get to adjusted EBITDA break even, that would say, hey, you have to add about another $105 million of in-force premium to get to adjusted EBITDA of 0. So it sounds probably a little bit too low, but might be in that ballpark, in that range is where they would be tracking to. Another positive thing from this quarter that I think was a surprise to a lot of people was this note about Europe, that 30% of net new customers came from our European business as compared to a mere 3% 18 months ago. So this is exciting because all part of the Lemonade story, Lemonade thesis, is that they're really going to be all over the world in all kinds of markets and able to absorb and take in the best customers in renters, in pet insurance, in any other of these niche, smaller product lines, serve them efficiently, have some of the very best in-class pricing, but great loss ratios, and then bundle these customers up to other product lines. So they also say in the UK and France, we expect to launch homeowners insurance later this year. So, and then their impact to register in 2025. So they're building out their product base in Europe, and then they're going to have homeowners. Also interesting, they note that there's more freedom to adjust prices dynamically without pre-approvals in Europe versus the U.S., where there's more of a slower regulatory environment, is my understanding. So in Europe, you might be able to more dynamically adjust and say, yeah, oh, now this pricing is actually got a little bit more or a little bit less, or maybe we really don't want this person or customer based on different factors or things like the Google search that brought them into by the product line, so maybe we can price it a little bit higher. They have a lot more freedom then to make those adjustments in Europe. So it could be a really great market and exciting to see those steps. And then the other positive thing that they talk about is that they're planning to accelerate growth further in 2024, and it seems like even beyond that. So they're back into this. That they're showing is more like 26% year-over-year growth by the end of 2024. And actually wonder, are they going to surpass that growth? My hunch right now would be yes. I'm going to do further analysis on that, but that leads us to our two kind of concerns that I have and reasons that I think why the stock was falling after hours. And I tweeted this out earlier. I said, I think the two reasons that are really sort of making the market feel uncertain is that, hey, the letter basically said home and car loss ratios, they're not so good. And also the letter said, hey, our guidance for Q1 and for 2024, it's kind of weak. It's not that strong. It's not that great. First of all, let's talk about the guidance. For me, I think it's less concerning because I focus on not really the optics of the company, but I focus on the core actual company itself. So if they're guiding, I in my mind, guidance, it's really simple. You should just guide for what you actually think. And then if you beat it by a bit or you're lower than it by a little bit, it's not a big deal. But guide for what you really believe you're going to accomplish. So it is a little bit frustrating to me that the guidance seems to always be consistently way underneath. Matt had a great tweet. He said, this is just a friendly reminder that last year's full year 2023 guidance at the end of what high end was $700 million versus actually came in at $747. Revenue of $379, actual $430, and adjusted EBITDA loss of $245 versus actual of $173. And I literally remember I did a video that called this out like soon after about a year ago. I did some analysis and was like, there's no way that these numbers make any sense. Like, there's a much better chance they're going to be not a loss of $245 million, but under 200, like even 170, I think I was suggesting that could be reasonable numbers for the year. That's where they actually came in at. So I'll have to do that analysis again with the numbers we have now and thinking about 2024 when there'll be another video. But again, then the numbers they gave here, if we scroll down to the bottom of the letter, seem really, really really low, especially from an adjusted EBITDA standpoint. Like, they just did minus 29 adjusted EBITDA in this quarter, and they're talking about improving adjusted EBITDA over and over. And then they have Q1's minus 43 at the low end or minus 41 at the high end, and then minus 155 for the year, even though, if we again flip back to my model for the full year 2023, they did like 162 for the full year. So 162 for the full year, and then they guide like, yeah, we're going to be like 2 million better for 2024. It's like that doesn't really spark confidence into you as an investor base. Or as the market as a whole, that we're on this path of profitability. It's going to keep showing consistent improvements. But my guess is they're going to absolutely crush these numbers again, and this is just very, very conservatively guided. And again, for me, it's like that's not the end of the world, because it might just present me, if I understand that, then it might just present me as an investor with a better buying opportunity over a longer span of time, where other cash flows I have, as those cash flows trickle into my own life, I can invest those into the company that I feel that's undervalued for longer. So it's not the end of the world to me as long as I understand it. But in my mind, guidance should be pretty simple. You should just guide for what you think is actually going to happen. And if Lemonade just consistently way under surpassing that, it is sort of frustrating and kind of odd, because it is, if anything, it causes some confusion in the investor base, because it's hard to kind of reconcile these numbers with the whole greater picture that, hey, they're on this path to profitability. But again, I'm not very concerned about these numbers, because I'm thinking, they're going to probably beat these very handily. It's just more of a matter of how much. And even the top line numbers, I'm going to look in those as well. So they have about whatever it is, 25, 26% year-over-year growth. It's like, I'm going to look into that, and I wouldn't be surprised if they surpass that. And rather than, just like Matt pointed out, they were about 47 million more than their original IFP guidance. I wouldn't be surprised if they do something similar like that again, and maybe they actually hit 1 billion IFP, or a little bit over 1 billion IFP at the end of the year. And then the other question mark I think the market has, basically their letter said, hey, home and car loss ratios must not be good. And if you read the letter, they had different sentences like this that said, LTV is very robust and little change from prior models, talking about their new LTV model. But we may have been overestimating the lifetime value of our car, and to a greater extent our home customers. Basically saying, hey, our home and car customers really are struggling, really not that great. And they don't talk about too much more about car, but they do talk about homeowners, and the whole sort of section here in the letter that says, hey, the amount of we've really tried to avoid certain homeowners. We've cut back on premiums that were written, so they've really avoided risk and cut back in these areas. But it does make you wonder, as I wrote here on Twitter, like, are their models really working? Are they really valuable? Do they have any value to them? And the big question for me is can they become excellent home and car insurance providers? I mean, I think that's a valid question. Can they make that sort of switch and have really excellent, leading, best-in-class home and car insurance product lines and be providers in that area? Or will they continue to struggle? Because that obviously has huge implications, whether they really struggle in these areas and they're really sort of unprofitable business lines, then it doesn't matter if you build this nice base of renters and pet customers that may be profitable in their own way, but you can't upgrade and have that sort of 10x premiums bundling effect on customers that spend $100 a year on renters insurance, or $150, and now spend $1,000 or $1,500 on home insurance, for example, or car, whatever it is. So without that is a huge part of the thesis, and it kind of raises questions. Hey, you're really struggling. Like, can you really get it together, And then they even have this line say, we will begin a pilot next quarter of selling homeowners insurance using third-party paper. This means Maya will be using the lovable onboarding experience to sell policies that are underwritten by another insurance company. So then you kind of wonder too, like, sure, that might be great. They do all the sort of sales upfront provision for it, but then wasn't some of the point and sort of part of the thesis that they had these advanced systems that could really cherry pick the right customers and grow with those customers who have this really high LTV. So it's showing here, and they basically, admit here that, hey, previous versions had some inaccuracy and they're getting better now, but car and home to a greater extent really weren't as good as we were even thinking they were. But then actually, as I digested this all further and thought about this point about home and car loss ratios just in the last few hours before making this video, I kind of realized, in one hand, and they actually say this in the letter, it says, as our filings for home and car get approved and implemented, these will boost the LTV of customers buying or renewing these products, and the system will adjust in real time. So on the one hand, there's probably still a lot of these product lines, customers that haven't renewed their products yet at the higher premiums and will be in the next year, because Tim Bixby said it said last quarter, and he replied to me on Twitter that over the 2024, they're going to be adding about another 100 million in premiums simply added from rate increases. So my guess is still a lot of these customers that have home or have car, they will have some sort of renewal at probably a fairly higher rate. I mean, we know in Q3 they had, I think it was the end of Q3, they said they had a 50% rate increase approved for California. So, customers who might be in California but haven't renewed their insurance yet for their annual insurance, and that renewal might be coming still sometime here in 2024, and then they get bumped up to those higher rates. So, which of course is going to have a huge effect on the loss ratio of home and car, and of course how valuable those customers really are. So in my mind, it's pretty clear, they're not trying to go to the moon. They're not asking us to solve the most impossible problem. All they're trying to do is say, hey, what we're freaking out about, and what I'm pointing out here is, hey, the loss ratio for home and car are not good enough. And so all that means is, hey, your pricing is wrong, you're going after some of the wrong customers, so you have a bit of a selection problem, and you probably have a pricing problem. And some of that pricing problem, as they say in the letter, is probably, as we pointed out here, is probably being fixed as people renew these products. It will slowly fix itself anyways, that pricing problem. And if they need further rate increases or certain adjustments there, I'm sure they'll make them. So that should fix itself. We're not asking them the most insanely difficult problem to solve it. It's like a very solvable problem that it probably just, in insurance, it's a slow industry, needs time to solve. So that's sort of my own relief about my own thinking and relief around this. And that's why I tweeted this out earlier saying, hey, there's people freaking out about these couple things here. But really, you got to zoom out and think about the much bigger picture is they had a really strong beat on adjusted EBITDA. Really strong, under 30 million. And they're firmly on this path towards profitability, probably by, 2026 range. So if you think about that, that's great. That's what really matters, is that if they weren't on if adjusted EBITDA was down here, I would be concerned, and we'd be like, what is going on? And there's a much more serious underlying problem. But if you think about it, it's way down here. This is really positive, great news. And yet we're freaking out about, home and car loss ratios, which again, I think is a very solvable problem. And we're freaking out about guidance, which again is really just an optics thing to the market. It doesn't tell you anything about actually the business itself. And my philosophy as an investor is I literally think I'm buying this business and I'm a business owner. If I'm buying a business, I don't care about the optics of the business. I care about actually what the business can deliver. So that's my take on the guidance. That's my take on the home and car sort of concerns, and those are some of my highlights and still reasons why I'm very bullish and excited about Lemonade and this company. Thank you so much for watching. Remember, it's in the bag.